Good afternoon, everyone. My name is Sarah Scruggs. I'm really glad you joined us today for a session on conquering your credit. Sarah Collins, who works at Brigham and Women's Hospital, wanted us to give a quick introduction. She can't be with us today, but she did want to let us know that this series is provided by HUECU through the Office of Employee Engagement and Wellbeing. For more information on financial education programs and other well-being topics, you are always welcome to contact Sarah Collins. So don't hesitate to do that. We'll get started today just by talking about today's webinar and the format that we're going to be using. Everyone has been muted so that hopefully you can just hear us today. And that way we can get your questions through the questions feature and the chat feature. And this feature is located on the right-hand side of your screen or at the top, depending on how you logged in. You're more than welcome to use this feature throughout, and we'll answer those questions at the end. And then you will be getting this presentation and resources that we have from our website in an email after this presentation has ended. So don't hesitate to reach back out to us if there are questions that come up later. Harvard University Employees Credit Union, or HUECU, is a not-for-profit financial institution of Harvard University and all of the teaching hospitals. So we are glad to provide everything that your normal, larger financial institutions may provide, but hopefully in a more personal way. And we're able to work on these personal finance education series like we have with Brigham and Women's Hospital. We have convenient locations across Cambridge and Boston. So if there's anything that we can do for you now or in the future, don't hesitate to reach out to us. This is an ongoing series with Brigham and Women's Hospital. So please, if you're not able to attend any of these, do know that they will be posted on our YouTube page and on this website so that you're able to see them and that you're able to look through these and go back and see this information more than just once. So you can also sign up for our next two on student loan repayment and home buying. To dive into our topic today, we want to talk a little bit about credit and what impact this has on your everyday life. A lot of us may not know our credit score, may not know the state of our credit at this point, but something we do want to make known to you is that it can impact your everyday life. So you see that this 36-month car loan, this is just an example of a 36-month car loan. You see the credit scores all the way to the left, and then you'll see the monthly payments and then the additional cost in a year based on your credit score. So you'll see the APR is the amount of interest charged on your car payment. And as your credit score gets higher, the APR gets lower. So you're getting charged less interest with a higher credit score. So you can see having a lower credit score around 500 to 589, you're going to be spending an additional $5,724 over the life of the loan, which is quite a large amount when you're thinking about this versus possibly having a 740 credit score where you're not spending that additional $5,000. You can do a lot with $5,000. So here we're going to talk with you about your credit score, but then also some strategies for raising that credit score. How does credit work? This is a question that I think a lot of people have, but sometimes they're too afraid to ask. This is utilizing something now and paying for it over time. So this is borrowed money. This is a loan. This is a credit card, but it is not a debit card and it is not your income. So your credit really only has to do with the amount of money that you've borrowed and not what's coming in or your income or the paycheck that you get. Credit bureaus. There are 3 credit bureaus in the United States, Experian, TransUnion, Equifax, and we like to think of these guys as Google, Bing, and Ask Jeeves when that was around. These 3 are different search engines for people who give out loans to know how your credit is. All of these credit bureaus give you a little bit of a different taste of what that credit looks like. So not all of these credit bureaus report all of the same things. So you may see some differences in between your Experian credit report versus your Equifax credit report. These collect financial information from all of these people so that they can come up with a better picture of how you've been in the past with your borrowed money. So this is good for people to see who are thinking about taking large chunks of credit. You're thinking about getting a car loan. You're thinking about buying a home in the future. It's good to know what these credit bureaus have so that you can see what the lenders will see. What do credit reports entail? They reflect your current and past uses of debt. And so these can go back for quite some time. And so it's good to know that all of these debts can be on your account. There are some that may fall off if you've paid up that balance. There are some that may stay on there. And you may be wondering, well, for how long are these specific things staying on my credit report? And it's good to know that once you've had a credit inquiry, so maybe you're thinking of getting a new credit card, you have a credit inquiry. In 2 years, that will fall off your credit report. So that's not staying on there for too long. But if you've had a Chapter 7 bankruptcy, that's going to be staying on there for 10 years. So you can see how those two things have different effects on your credit report and how a person looking at your credit report would see those two things in a different light. Filing for bankruptcy versus a credit inquiry is a very different thing in lenders' minds when they're looking to see, is this the person that I'd like to lend to? And maybe you're wondering, well, how can I see these things on my credit report? Well, annualcreditreport.com is the only website that's authorized by federal law to provide you with a free credit report. And so this is a great place to go if you have questions about your credit report. And right now you can receive a free weekly copy of your report from each of the 3 bureaus until April 2021. And so it is a good thing to be able to see more of your credit report. So take advantage of this. This is due to the coronavirus, so we don't know if this will extend past April 2021, but right now we need to take advantage of this so that we can see, is there anything on my credit report that looks like it wasn't reported correctly or something that looks a little off? You can go here and see those things. So what does a credit report look like? The first one that you're going to see at the very top, you'll see that it has a lot of different details on it for just one account. This is a credit card. You'll see that at the very top so that the lenders know what type of credit you have. This is for a credit card, and you'll see the payment status, and this payment status is current, which means that they are on time with all of their payments. So they've not missed a payment. You can see that the past due is empty. But the one thing that we do want to point out on this particular credit report is that you see the credit limit is $5,500. And right next to it is the high balance that they have carried on this credit card, $5,429. That is quite high, very close to the credit limit of this card. And so lenders are able to see this and see that, well, maybe they made, by pushing it that high, they may not have been able to pay all of that back. And we don't see, that they paid all of that off. They could have paid all of that in 1 month and then paid it off at the end of the month and they would have been fine. But on the credit report, we don't get to see that. So that's why we encourage people to keep their balance to 30% of their credit limit, because you want to make sure that creditors see, or that lenders, see the best piece of how you use your credit wisely. And then you'll see this next piece of the credit report from Comcast. Normally, utility companies don't always report to credit bureaus. The main times that they'll report is through collection agencies. So if you've missed your payments and you have not paid for it. And so you'll see here that the past due amount is $310. That is not a huge balance. It seems like something that somebody could pretty easily pay off in at least a couple of months. And so you'll see that the payment status is seriously past due. So that means that this person did not finish paying their cable bills and possibly moved out. I know that this has happened sometimes if you share an apartment with multiple roommates and you think that that you've paid all your money to Comcast, you're good, but maybe your roommate has forgotten to pay them. And this could show up on your credit statement. So you want to make sure that all of these things are paid up and on time. You may see errors on your credit report. What do you do when you see these errors? The first thing you need to do is to contact the credit bureau in writing and inform them of this error. They have 30 days to investigate this. That does not mean that their investigation will take 30 days. That means that they have that time to let you know their plan of action. And so you also can contact the lender or the provider that you're disputing the error with. Sometimes they can correct it themselves. They're able to go back and correct that. So those are two options that you have. If you want to write a letter to a credit bureau, there are sample letters online that you're more than welcome to use from. So if you do see something that's wrong, whether it be human error or computer error, things like that happen. So it's good to check our credit reports and then dispute those errors when they do come up. So what happens if your information is compromised and there's a case of identity theft, or if you see that somebody's using your email that had a password that could possibly pertain to pieces of your identity? One option is a fraud alert. A fraud alert is for 90 days. You set an alert on your account that says, go through additional steps to check my credit, to pull my credit is what we say. So you have to set this with each bureau. You can't just do it for one, you need to do it for all three. And this way, if somebody is trying to get something new with your credit, you will know because you'll have to go through extra steps to be able to get that credit report pulled. And this is for 90 days. It can last 90 days, and you can go back after the 90 days is over and reset the fraud alerts. But this is a good thing to do if you're just nervous, okay, something possibly could have happened. This is a good first step of action. Another is a credit freeze. A credit freeze is something that's on there indefinitely, but they have to go through extra steps to pull your credit again. So this is on there indefinitely, whereas the previous was 90 days. So this is a good option if you really just want to make sure that you're good to go and that your credit is safe from possible identity theft. And again, you need to visit each bureau. There is no one place to go to do this. You have to do it for all three. And then if you are no longer interested in receiving credit card offers, this is something that is probably the most popular thing on this presentation is optoutprescreen.com. You can go there to say you no longer like to receive credit card offers. And this is something that people do. Let's say if they feel like, okay, I've got enough credit cards, I have the offers that I need, I'm not interested in getting another one for the next 5 years. This is something to go ahead and do. But if it comes to a point where you are starting to look for offers, then you are going to need to seek those out yourself. So this is something to do if possibly you are thinking, I'm not interested in receiving any more offers at this point in time. So this is something that you can do if you're interested in that, but you don't have to. All right, Magdalia, I'll hand it over here so that you can take us on to talking about our credit score more specifically.
Thank you, Sarah, and thank you everyone again for joining us. So now that we have an understanding of exactly what credit is and credit report, what exactly goes into managing our scores? That tends to be most of the primary reason that a lot of us know about our credit, because we get asked that question when we're applying for something, or perhaps family or friend conversations will lead you to, what is that credit score that you have? Well, to make sure that we all know what the credit score is, we're going to take a couple minutes to talk about that and then go into what affects the actual credit score. The credit score itself is measuring your credit risk, or essentially your ability to take on credit in relation to the debt that you have had in the past. It is going to be different for each bureau and each score model. This is something that you've seen consistently with what Sarah has mentioned before. There isn't one standard way of doing a credit report. There isn't one standard way of getting a credit score. So as we're talking about this, keep in mind that we're really talking about high level, because all of these are algorithms that are managed differently and outside of the credit bureaus. Think of the credit bureaus as as your transcript. It's a high school transcript, college transcript. It is accumulating information, but then your grade point average is the number that's derived from the information on that credit report. The two entities that will manage the credit scores are FICO score and VantageScore. These are, think of it like Pepsi and Coca-Cola. They're different, but have their similarities. The higher the credit score, ultimately it is going to be better for you because it's going to give you more options. Now, credit scores themselves will range. There are some models that will have a credit score that will go up to 850. There are some that will have it go up to 830. There are some that are different even from that. The biggest takeaway is that ultimately, depending on when you're going to borrow credit, that is when you want it to be at its highest, your credit score. Because the higher that credit score, the lower the interest rates that you are potentially going to be charged, as Sarah showed at the beginning of the presentation. If you have a credit score of, let's say, 650, we don't want anyone to feel, oh, that's a bad credit score. I'm never going to be able to get credit. Not necessarily. There are other things outside of credit scores and credit reports that could impact your ability to be eligible for a product such as a loan or a credit card. But specifically, when it comes to your credit score, there are certain things that you can do to try to bring up that score so that when you are looking to borrow, you can have the best options available to you. This is an example of what it looks like when you get your credit score. When you go to annualcreditreport.com, you're not going to get your credit score for free. You would have to pay for that. That is, again, separate than the credit report. However, a lot of financial institutions, including us at HUECU, offer credit score for free. This is something that you can typically download on the app if you have a credit card with the company, or many other financial institutions will provide this as well. So you can typically get your credit score for free if you have a relationship already established with that lender or financial institution. Here you can see what I mentioned earlier about having different score options. This one is the FICO score 8. There are other FICO score options. There's a FICO score 9. Recently there was a 10. There are others as well. So think of them as different versions. For us as consumers, ultimately, it doesn't really matter for us which one a lender is utilizing. If we tend to have a fairly good credit score, it's going to be fairly good across all of them. If we have a lower credit score, it's going to be lower across all of them. So the score model will change the score number, but essentially you're more or less in the same range. And the same is true depending on which credit bureau is pulling your credit score. So an Experian credit score will not be the same as a TransUnion or as an Equifax. They will differ slightly, but again, will more or less be within the same range. Here's the first option, just showing that this individual, we pulled their credit score, it was a 488, and it's telling us that it's a FICO score model 8, and it gives us the range so that we can then look at that 488 and place that within that range to have a better idea of if it's on the lower or higher score. Now, there are going to be score factor descriptions. There are going to be certain things that are always going to be described regardless of what your credit score is. So as you can see here, even when you have a 748 and when you have a high 800 score, you're always going to have a comment. It's, again, going back to that idea of the report card, a teacher will always write a comment. It might be great to have in class, even if you have an 850, like there's something that's going to be said. When your score is lower, those factors are going to have more of an influence. Here on the one that has 488 score, we can tell that they have serious delinquency, meaning that they have not paid their credit cards as they were supposed to, or their loans, or a cable bill. As a result, if they resolve that, that's going to help them improve their credit score substantially. If we look at the person that has a 748, the lack of recent installment loan information, which essentially means they have not had a loan recently. That does not mean that they should go out and take out a loan just for the purpose of taking out a loan. There are other things that individual could do to bring up their credit score. So the higher your score gets, you still always want to read the score factors, but you don't want to necessarily make an action based off of those without getting more information on your specific situation. This is an example of what goes into the FICO score. This is a very high level. It doesn't mean that it's going to be exactly 10%, exactly 15. Typically, it will be within that range. But because credit is based off of what's on your report, and because depending on which credit model the organization is using, could vary here and there. So here, it's really the big concept that we want to focus on. When we are looking at what impacts our credit score, the biggest piece will be payment history. And that sort of makes sense. If you had to lend money to someone else and you found out that that person you were going to lend money to doesn't pay people back, you most likely wouldn't want to lend to them. And that's essentially what payment history is getting to. Is this individual going to pay the money that they borrowed? 35% of our credit score is based off of that. So if we're in a situation that we have had payments that have been late and now start making our payments on time, that in itself may be enough to help bring up our credit score. Keep in mind though that credit scores typically will take about 6 months, sometimes less, sometimes more, but usually around 6 months for you to see a substantial increase in a score. So if you were paying late for the past year and all of a sudden paid one bill on time, that may not be enough time for your credit score to increase, but you still want to maintain that behavior because after a while, it will help improve your credit score. The 30% amounts owed, this is what Sarah mentioned earlier when she showed that example of a credit report and that individual that was very close to their credit limit. It is important to try to maintain the balance that you carry either on your credit card or in a personal loan under 30%. It could even be 0%. You can purchase something, pay it off in full. You don't have to maintain a balance. But if you are maintaining a balance and you notice that it's over 30%, that may impact your credit score and it may impact it in a way that it's going to be negative. But once you start paying it off and are able to pay more than even that 30%, that can help bring up your credit score. New credit is what we've heard being referred to as a hard pull or a soft credit pull. This essentially means that whenever you apply for a new loan, so not when you're looking for information on yourself, not when you're going to see your credit report, not when you're doing financial counseling, which we'll talk about shortly, but when you're seeking new credit, that is called a hard inquiry. And that in itself will impact your credit score about 10%. I do say about 10%. Everyone's credit file will be different. I know I recently pulled my credit. My credit did not decrease by 10%. There was a slight decrease, but it wasn't that substantial. So this is why it will more or less depend on your specific situation. The length of the credit history, this means that individuals that have had credit for longer have a larger, typically, credit file, meaning that the lenders, the credit bureaus, they have more to look at when determining that individual's credit score. As a result, having a longer credit history tends to be more advantageous because there is more, and as a result, typically you have a higher payment history, you have had more time to get your amounts owed. So there are other factors that impact it. I do hear the question often, should I close an old account? It really will depend. For some individuals, if you close an old account and you only have two, one that you've had for 15 years and one that you've had for maybe 1 year, yes, that's going to be a significant loss of history if you close that older account. But if you have had credit for 15 years and you had an account for 15 years, one for maybe 12, one for 10, etc., that older account, yes, it's older, but it's really, they're looking at the average of your the average length of the credit history. So it's not going to have as much of an impact in that situation, typically. And then there's credit mix. Credit mix indicates the type of credit that you have borrowed. There's installment loans, which are your standard student loans, mortgages, car loans. You borrow X amount and you pay X amount for X number of years. So it's very standard. It's paid off in installments. And then you have credit card debt, which is revolving. Credit card is revolving because month to month, as we've seen, as we've experienced, our credit card balance will typically not be the same month to month. It will revolve. A good credit score typically will have both, but it is not necessary. So if you don't have an installment loan, doesn't mean you should go out and get one. You can definitely have a good credit score without having both. This is the other way that the credit scores are generated. This is the VantageScore model. The FICO model, which was in the prior screen, about 90% of lenders use it. The VantageScore is it's a newer model, and it has started to be used by more and more lenders, and it is becoming more popular. As you can tell, it's very much similar to the FICO score. It's about payment history, type of account, credit limit, available credit. So this is more or less the same. It's just like Bing and Google, different ways of producing a similar product. And in this case, that product being our credit score. With credit and credit score specifically, our credit score is a snapshot of our current situation with our current ability to manage credit. This means that if I miss a payment today, my credit score is going to be negatively impacted today. It's something that happened recently. But if I miss a credit card payment, let's say 5 years ago, and have been paying on time ever since and everything else has been good, that missed payment from 5 years ago is not going to have as much of an effect on my credit score today. So things that happen today or about 2-3 months ago, that's going to have much more of an impact. If something happened years ago, yes, it will still be on that credit report. As you saw with the credit report timeline, what stays on, most things will stay on for about 7 years, but the impact on your credit score will be reduced substantially, and even to the point that it may not have an impact on your credit score, although it may still be on that credit report. There are many different ways that you can improve your credit score. We're not going to get into all of them because it would be a disservice to you because we don't know your specific credit information. Additionally, we are not accredited credit counselors. But one of the benefits that you have is all of you have access to Green Path Financial Wellness. They are accredited credit counselors that partner with us at the Harvard University Employees Credit Union to provide all of those in our community, including all of you at BWH and through MGB, the opportunity to access free credit counseling. There will be an accredited credit counselor who over the phone will pull your credit report. It's a soft credit pull. It will not impact your credit score, and they will go through your specific credit report and give you pointers as to how you can improve your credit score. And if you think you have a good credit score and just want someone to check, you can also do that. So you don't have to wait until you have a low credit score to call. Think of this as a checkup. We want to make sure we're always feeling healthy and doing well, so it's preventative. We go before there may be an issue. Pulling your credit report and doing a credit report review is very similar. Oftentimes when people think credit reports and credit scores, we sort of stop there, but we always like to take a moment to talk about choosing a credit card or any other sort of product that could be out there. When you're thinking about choosing a product, you want to make sure you're reading the fine print. And this is where they're going to have to disclose to you things such as what are you going to be charged? What is that annual percentage rate? What is the balance transfer fee if it is a credit card that you're doing? Or what are other possible fees that you could be charged? The lower your credit score, the higher that annual rate that they are going to charge you. So you want to make sure that what is on the website and what may be promoted may not always be what you're eligible for. So as we're talking about credit scores and we're talking about credit reports, keep in mind that anytime you apply for a product, you want to take the time to read the disclosures, read what you are signing up for, because the advertised rate may not always be what you may qualify for. I know we went through a lot of information about credit reports and credit scores, and we know that it can be overwhelming. There's a lot to learn. One of the things that I want to point out is we do have, in addition to Green Path financial counselors available to help you with a credit report pull and help you with a customized solution for your credit situation. We also have our blog.huecu.org, where we have credit articles, and we also have our social media accounts where we'll continue to provide tips as well when it comes to credit.